appreciate it. I am increasingly concerned about what Mr. Harris described as the diminishing returns of increased regulation when a regional bank is spending $200 million on compliance projects and hiring 500 additional non-loan officer staff. It really makes you question who's benefiting. Certainly not the customer looking for a loan to build a home or start a business or, pay for a child's education. And a lot has already been said today from members on both sides of the aisle about how the current $50 billion threshold for enhanced prudential standards is the wrong one. And I'd like to ask Mr. Kinney, you in your testimony describe how this is not the only place that the number's been applied. In fact, it's become what you termed a systemic risk lodestar for the federal financial regulatory agencies. Where else has this been applied since you raised that issue? And under today's regulation, what's the difference between being a $49 billion bank and a $51 billion bank?
Thank you, Congressman. I think you're exactly right. The $50 billion threshold is now used in a number of different contexts beyond what's dictated in Section 165. So to give one example, regulators have dictated that certain enhanced compliance requirements apply in the regulations under the Volcker Rule for $50 billion banking entities. There's no statutory directive to do that, but this $50 billion concept is embedded there. It's embedded in certain governance and risk management standards that the comptroller of the currency has adopted. So it is kind of expanding in a number of different areas that are not required by the statute. And I think that's because the regulators are looking at Section 165 and pointing to it and saying, well, Congress made a choice here on $50 billion, so we're going to adopt a $50 billion threshold as well. So the end result seems, and two, the imposition of regulatory requirements that are beyond what the set that we've been talking about up to now on bank holding companies once they cross that $50 billion mark.
So you're saying that regulators have used the flexibility given to them under current law to apply the $50 billion threshold elsewhere, even when not required, and they have not, as some have suggested, used the flexibility to tailor the regulation based on the risks posed by the bank.
I think that's a fair statement. I think they have, in various contexts, used $50 billion elsewhere where there's no requirement to do so, and they haven't done, in some of those cases, like in the Volcker Rule, there's harder standards at 50 than below. So
here's my question. Could the Federal Reserve on its own raise the CCAR level to $100 billion or $250 billion? If, as Dr. Johnson suggested, the $50 billion threshold is not a systemic risk designation, then wouldn't a higher number make sense for stress testing?
The Federal Reserve could vary different types of stress testing above the $50 billion level, but it has to apply enhanced capital requirements at $50 billion, and it has to apply Dodd-Frank stress testing, so DFAST stress testing, at $50 billion. And as a matter of fact, Governor Trullo has really asked, well, does that make sense to apply some of that level at $50 billion?
Okay, my last question to you would be, have other countries around the world adopted the bright line $50 billion asset-based threshold here? And also, did the Federal Reserve advocate this approach when the Basel Committee was designing its methodology for determining systemic risk regulation?
I'm not aware that the Federal Reserve advocated for the $50 billion. As a matter of fact, the Basel Committee uses a much more nuanced indicator-based approach when it looks at globally systemically important banks, number one. And number two, when the Federal Reserve has considered mergers under its bank holding company authority and has been directed by Dodd-Frank to look at systemic importance, it too uses a much richer and nuanced analysis, which suggests that when the Federal Reserve is not directed to use $50 billion, it too would use a much more nuanced approach and a much richer analysis as determining systemic importance.
Thank you, Mr. Kinney. I appreciate it. Thank you, Mr. Chairman.